Why Jackson Hole can matter more than an FOMC meeting. Every August, the same headline appears. Federal Reserve Chair Jerome Powell is set to speak at Jackson Hole. And almost immediately, stocks become volatile. Bitcoin starts moving. The US dollar can swing dramatically. But here's the question: why? Jackson Hole isn't an official policy meeting. No interest rates are announced. No votes are taken. So why can a speech delivered in a small town in Wyoming move trillions of dollars around the world? Today, let's look at what Jackson Hole really is, and why, in some years, markets pay even closer attention to it than an FOMC meeting. The first thing to understand is this: Jackson Hole is not where monetary policy is decided. The Federal Reserve doesn't walk onto the stage and announce, "We're raising rates today," or "We're cutting rates next month." Those decisions are made at official FOMC meetings. Jackson Hole serves a very different purpose. It's one of the most important opportunities for the Federal Reserve to communicate directly with financial markets. Why is that so important? Because central banks hate surprising investors. Imagine if the Fed suddenly announced tomorrow, "We're raising interest rates by 1 full percentage point." Stocks would likely plunge. Bond prices could collapse. The dollar would surge. Financial markets around the world would react violently. Central banks know this. That's why they usually prepare investors well in advance. They send signals. They adjust expectations. They gradually shape market thinking before making major policy decisions. Economists call this forward guidance. In simple terms, it's the process of preparing markets for what's coming before anything officially happens. And Jackson Hole has become one of the most powerful stages for delivering that message. That's why investors don't just listen to Powell's speech. They analyze every single sentence. Sometimes every single word. Take a phrase like this: "We will remain data dependent." To most people, it simply means, we'll make decisions based on incoming economic data. Nothing extraordinary. But professional investors hear something very different. Some interpret it as a sign that interest rate cuts are getting closer. Others conclude the Fed is still worried about inflation. Others believe higher rates may remain in place longer than expected. The words themselves don't move markets. The expectations they create do. And those expectations spread almost instantly. Within seconds, economists publish their interpretations. Trading firms update their forecasts. Financial news outlets push out headlines. Algorithms scan every sentence in real time. By the time most people finish reading the first news alert, billions of dollars may already have changed hands. That's how modern financial markets work. They're constantly trying to price in the future, not the present. Now you might be wondering, if this is all about US interest rates, why does Bitcoin react? The answer is simple. Bitcoin is no longer traded mainly by retail investors. Today, a large share of Bitcoin is owned and traded by institutions. Pension funds, hedge funds, asset managers, ETF providers. These firms don't manage Bitcoin in isolation. They manage entire portfolios that include stocks, bonds, commodities, and cryptocurrencies. When their outlook changes, their entire portfolio changes. If they expect higher interest rates, they often reduce exposure to riskier assets. That can mean selling technology stocks, selling growth stocks, and selling Bitcoin. That's why Bitcoin often moves alongside traditional financial markets during major Federal Reserve events. It's no longer operating in a completely separate world. So what are investors actually listening for? Surprisingly, not the words, "We're raising rates," or "We're cutting rates." Instead, they're searching for subtle clues. Phrases like, "Inflation continues to moderate," "The labor market remains resilient," "Economic activity has slowed," "Financial conditions remain restrictive." These may sound like ordinary sentences. But even a slight change in wording can alter expectations for future interest rates. And when expectations change, markets move. Sometimes dramatically. This is why, every August, professional investors around the world pay close attention to Jackson Hole. Not because policy decisions are announced there, but because it's often where the Federal Reserve begins shaping the market's expectations for future policy. In many ways, Jackson Hole gives investors a glimpse into how the Fed is thinking before the next official meeting ever takes place. And sometimes, that shift in expectations has a bigger impact than the policy announcement itself. So the next time you hear, Powell is speaking at Jackson Hole, don't think of it as just another economic conference. Think of it as one of the world's most important conversations between the Federal Reserve and global financial markets. Because in investing, expectations often move markets long before decisions do. And that's exactly why, in some years, Jackson Hole matters even more than an FOMC meeting.